3 straight days of losses. Can we turn it around this Tuesday? 30 minutes until the start of your cash equity trade. I'm Danny Berger.
And I'm Isabel Lee. Bloomberg Open Interest starts right now.
Coming up, tech takes the lead. The Nasdaq pushes higher as investors return to chipmakers.
And stocks shrugging off Middle East tensions. The U.S. and Iran trade strikes for a 10th straight day. And
Novo Nordisk sues Eli Lilly, accusing its rival of misleading ads for blockbuster weight loss drugs.
Danny, we have a lot to watch on this Tuesday, which we talked about as not our favorite day, but today will be a great day because you and I are together. And here is where we stand. You're looking at green on the screens. Tech is really lifting the broader market this morning as investors buy back AI chip stocks at a cheaper valuation. So we have a lot of fears over China's AI progress, and this is dissipating as we approach earnings, and we have big ones this week from Alphabet and Tesla. Tomorrow, you're looking at Nvidia higher by 1.5%, Intel by nearly 6%, and SanDisk up by more than 7%.
I'm loving all this positivity, both the market and you this morning, Isabel.
Oh, yes,
I needed that.
green.
I think we all can use that in these strange times. Isabel, I'm also looking at GM this morning because they raised their full year profit forecast by another $500 million. They beat second quarter earnings estimates powered by stronger margins on its large trucks. And you can see shares only up, though, 0.25%. The company's CFO also joined Bloomberg surveillance.
We've held in on price and demand as well, and that's remained consistent. So as we look at the overall energy price environment, it hasn't really impacted us. We're still selling full-size SUVs as quickly as we can make them, but we have a much broader product portfolio.
Joining us for more on GM is Bloomberg Detroit Bureau Chief David Welch. David, GM raised its full-year forecast and after beating second quarter earnings estimates, but the stock, at least in pre-market, was fluctuating. What gives, and what's your biggest takeaway?
Yeah, the shares are up just a little bit right now. It was a solid quarter. It was a beat, and it's also, I'd say, a modest upgrade on their guidance. I think there's sort of a lot of crosswinds here left and right, which is, first off, part of it was cost, right? They did better on mitigating tariffs, and their warranty costs were better. So it's not like there's an underlying profitability story that's growth-driven. It's more solid management and execution, which I think investors are pretty used to seeing from the company. They do a good job that way. But are they gaining market share? Are they exploiting new markets? That's kind of tougher to see. So I think investors are not kind of giving the stock a new look or re-rating it in any way. They're just kind of saying, yeah, this is pretty good. Also, they had lean inventories in the first and second quarter. They're building out of that, so they're replenishing some. How sustainable is that? The company's indicating it is because they're saying they could keep this momentum going into next year. But investors are going to wait and see on that, so they're not totally buying the story that it's going to be great going forward in the long term.
I wonder, David, and this is a question John Farrow asked the CFO. I would love to pose it to you. And what you're seeing from these numbers, does GM still have pricing power, even as the price of gasoline at the pump remains sticky above $4 and continues to move higher with this war now entering another kinetic phase?
The average price of a vehicle they're selling is $52,000. That's expensive, so they do. But you did see an uptick in incentives. And I'm just, anecdotally, if you go out on the web, I saw 0% financing deals on their pickup trucks, which, that's the cash cow of the company. So at the moment, they still have pretty good pricing power, but that could be shaky going forward depending on what happens with this war in the Middle East, with oil prices, and with the economy overall. It's stable at the moment, but there are risks, and I think the market might be reacting to that as well. The other thing, too, is they're looking at warranty assumptions here when they get to that $1 to $1.5 billion benefit in warranty costs. Keep an eye on that. Sometimes companies will have a great quarter with warranty costs, and then a few quarters later, they kind of give it back, which is, if they think their warranty costs are going to be better, they put less in their reserves, and then later on they pad it back up if they have those issues. It's almost a way of, putting costs in one quarter or the other. We've seen that from the car companies. It's just something I always keep an eye on whenever I see a warranty benefit in a particular quarter.
All right, David, thank you very much. That's Bloomberg's David Welch in Detroit. Now, the broader tech trade is surging as earnings roll in, helped by a report that TSMC is planning price hikes. Bloomberg Intelligence Global Head of Tech Coverage, Mandeep Singh, joins us now. Mandeep, we had talked about this earlier in the past couple of weeks, that a lot of this feels like a momentum sell-off, something mechanical. I wonder, as we get this drip feed of news and as we expect earnings, if this is kind of helping to turn around and give us, again, confidence in the fundamental story.
I mean, this week we'll hear from Alphabet, so the demand side would become clearer given, Alphabet has a cloud business that has $460 billion in backlog, and backlog has been growing really fast for all of these hyperscalers. So to my mind, there was some discussion around the open source Kimi model, how that's going to impact the closed model companies. But in the end, if you look at the big picture, it's really everyone wants more compute. Token maxing has been an issue in terms of leveraging these models, and everyone is trying to solve for that. But the demand should continue, and that's what I'm hoping to hear, when these hyperscalers report.
Mandeep, in general, the AI trade has driven a lot of the gains in the market, but also a lot of the volatility. From your perch, do you see that people are trying to maybe broaden out from that trade, especially with news over, I keep saying overnight because on Friday it was overnight. Last week, the China startup that again spooked markets.
Well, I think everyone is nervous about how much power these two frontier model companies have, Anthropic and OpenAI, in terms of raising token pricing. And if that is a deterrent in terms of adoption, then people want to know, eventually the prices of the hardware and these tokens should come down. That is what we have seen in the past. But right now, from what we can gather, everyone is supply constrained, which is what's driving the prices up. And the open source is just another illustration that maybe we have some broadening out in terms of, the two LLMs really having all the market share to more model companies that can provide the tokens, and that will drive some kind of decline in pricing, because that's the one thing that everyone is trying to solve for, is how can this technology really broaden out by having more models in the end.
And elsewhere, the world of circular investing and everyone investing in each other continues. Nvidia today disclosed the stake that it has in Nebius, about 9.3% stake in the neo cloud company. What would the advantage be for Nvidia to be investing in this company?
I mean, Nvidia wants more cloud providers. They don't want, again, the power to be concentrated with the three hyperscalers. They want to build another hyperscaler that's outside of these three, that is a big GPU provider, and that's where they're very supportive of CoreWeave, Nebius, because they want a fragmented world where everyone buys from Nvidia as opposed to three players who control 50% of Nvidia's GPU sales, and they'll have the pricing power. So they believe in a fragmented world when it comes to the cloud side.
All right, Mandeep, you're going to be so busy tomorrow, this week, and next week. Thank you so much for joining us. Mandeep Singh from Bloomberg Intelligence on all things tech. Turning to the Middle East, Brent is moving above $90 a barrel as the U.S. and Iran exchange strikes for a 10th straight day. Meanwhile, the Iran-backed Houthi militant group in Yemen is threatening shipping in the Red Sea. Let's get the latest from Bloomberg Washington correspondent Tyler Kendall. Tyler, any signals you're looking at from Washington and Tehran to see what direction this is heading?
Well, Isabel, we are getting some signals that mediators are actively working to avoid further escalation, as Bloomberg News confirms that Iranian officials are in Pakistan today for talks, though a White House official tells us that we should expect U.S. strikes to continue until President Trump chooses a different course of action and Iran lets up its grip when it comes to the Strait of Hormuz. The thing is, we haven't gotten any public indication that Iran is willing to lift its leverage when it comes to the waterway, as we saw another vessel attacked overnight, this time one that was linked to Kuwait. We got some new satellite imagery, some new data from research firm Kepler, which finds on average 10 ships transited per day Friday through Sunday, with almost all of them using that route that Iran controls and not the U.S. coordinated one. And now compounding the risks, as you mentioned, is that we have this new threat from the Iranian-backed militia group, the Houthis, saying that they are going to institute this maritime blockade against against Saudi Arabia. But new this morning, Isabel and Danny, Bloomberg News has reviewed a memo which says that the Houthis' warning is extending to any ships coming to and from Saudi Arabia's ports, not just Saudi vessels. So that is bigger than what we had originally believed the threat to be.
And Goldman Sachs warning worst case scenario, fourth quarter, if this continues, we could see oil at $120 a barrel. Tyler, for those who feel fatigue about the war in Iran, they can now concentrate as well on a trade war, with the president announcing 50% tariffs on Canada. What method are they using for this? We know Section 122 expires on Friday. And what does that say about further ability for this White House to levy additional tariffs?
Right, Danny, this is a really good point that we're up against this deadline for the Section 122 tariffs, which were implemented to basically be a stopgap measure to help the administration build back up that tariff wall after the Supreme Court struck down those broad-based levies under IEEPA. This is under Section 338 of the Trade Act of 1930. It is a very little-known provision, in part because it has never been used in this way. It has to deal with allegations that Canada has been discriminating against U.S. commerce. We got a few different examples from the USTR, including how some Canadian provinces have banned U.S. liquor sales. We'll see where it goes from here. Since this is untested, it could face some legal challenges down the road. I think it is much more likely that we will end up seeing the administration build back up its tariff powers through using Section 301. Those are investigations into allegations of unfair trade practices, and we've seen those used between administrations. They are considered to be much more durable from a legal basis, but this certainly was quite the announcement overnight. If it does end up getting implemented in full, it would mark the most severe trade action that President Trump has taken against Canada to date, though we should caution, Danny and Isabel, our own analysts at Bloomberg Economics, say that they do expect these tariffs to be tweaked, either delayed or canceled, and that this could be part of a negotiating tactic, since we know the U.S. chose not to renew the USMCA, setting up potentially years of complicated negotiations.
Tyler, thank you very much for your coverage. Bloomberg's Tyler Kendall in Washington, D.C. Let's get a check on your equity markets this Tuesday morning. 20 minutes to go until we start trading, and we are moving higher. A rebound in the NASDAQ. I would just caution, we were in a similar place yesterday morning, and we ended up losing steam, at least in the S&P, for 3 consecutive days of declines. Chipmakers, though, had a good day yesterday, and tech, again, continues to push higher ahead of Alphabet earnings tomorrow. Brent crude, that seems to be where the pain is, up 2%, now above $91 a barrel, and that's bullying yields higher by 1 basis point at 460 is where you see your 10-year yield. Some of the other movers on our radar this morning. Mobileye says its cloud-based driver assist technology will be integrated into select Stellantis cars in 2027. Shares up 3%, Isabel.
And 3M raising its forecast as a slow and steady turnaround effort is improving despite broader economic volatility. And the stock popping, Danny, more than 6%.
And a slew of positive earnings this morning. Hasbro also raised its full-year outlook on the strength of its Magic the Gathering card game business, which grew 32% year over year. And stay tuned, because in the next hour, we will be speaking with the Hasbro CEO, Chris Cox.
And coming up, the fight for the global obesity market is heading to the courtroom. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. The London Stock Exchange is moving to offer near continuous trading with plans to launch a 24/5 trading venue. The new venue is called LSE 24 and is set to operate from 5 p.m. until 7:50 a.m. So LSE is saying in a statement it's expected to be ready for client testing by the end of this year. And the U.S. and China are reportedly preparing to hold talks on AI in September. This is ahead of President Xi Jinping's planned visit to the U.S. that month. According to Reuters, the date for the discussion has not been finalized. Establishing a dialogue on AI was one of the outcomes of President Trump's state visit to Beijing back in May. And finally, Novo Nordisk is suing Eli Lilly in U.S. federal court. They're claiming that Lilly's advertising for its obesity shot, Zepbound, and diabetes injection, Mounjaro, is misleading. Novo says Lilly's ad campaigns rely on outdated weight loss comparisons with lower doses of Novo's own obesity shot, Wegovy, than what's currently available on the market. Eli Lilly has yet to respond to the claims. Danny?
Thank you, Isabel. And I know we're still out to Eli Lilly awaiting any response to this. For more on the lawsuit, we are joined by Bloomberg health reporter Madison Muller. Madison, Isabel summed it up basically there, but what are the details of this case? What are they claiming that Eli Lilly did?
Yeah, basically what Novo is upset about is that in Lilly's advertisements for Wegovy, or for Mounjaro and Zepbound, they're using what they say are outdated comparisons. So Novo was able to get a higher dose version of Wegovy approved earlier this year, but Lilly's advertisements rely on a head-to-head trial that was using lower doses of the drug. So there are updated weight loss numbers, but the FDA and the companies themselves usually discourage people from using cross-trial comparisons, so meaning using different trials to compare weight loss results or any other results. And so Lilly's advertisements rely on an actual head-to-head trial. However, Novo is saying now there are updated numbers, there's an updated higher dose version, and they should be using that instead.
It seems to me that, yes, this is a legal battle, but also a battle for investor confidence and market share.
Definitely. I mean, this is part of Novo's more aggressive strategy. They have a new CEO who's been in the role a little bit over a year now, and he's really trying hard to claw back any market share that Novo can from Lilly. If you guys will recall, Novo was first to this market with Wegovy and with Ozempic, and they really created this modern weight loss market. However, Lilly was able to pretty quickly overtake them over the last couple of years with Zepbound and Mounjaro, which are a little bit more effective for weight loss. And so Novo is sort of coming out swinging now and trying anything that they can to reel back in customers and investor confidence, like you said.
Well, so they have this new drug out, the higher dose. Do we have any idea of what the uptake even is of this newer dose, and maybe some of the other advancements that they are trying to point to and say, hey, this is better?
Yeah, that's actually a really good question. We asked Novo if they had numbers on this higher dose Wegovy uptake. They said that they didn't have anything for us at the moment, but it's something that analysts are probably really closely tracking. We know that in the real world, people don't always go up to the highest dose of these drugs. They can often get really good weight loss from lower doses, and the higher doses might have more side effects. So while in trials, people are supposed to go up to the highest doses of these drugs, that's not actually what we're seeing happen in the real world.
So how are you looking at this? Does this legal battle really change the competitive picture for you, or does it just really highlight that it's been such a crazy market? I mean, we always talk about all of these. I mean, peptides, weight loss, it seems like it's all the craze, even in Gen Z. Danny and I aren't Gen Z.
And you wrote a really good story about peptides this week, too. But
you helped with that.
It is all, I mean, we know GLP-1's peptides so popular, the enormous potential market opportunity. And I think that this trial is just the latest example of how competitive it is, that these companies are really willing to try any tactic to get a leg up on each other. And these two companies in particular have been rivals for over a century. And that is just going to continue. Clearly, they're not playing nice with each other, and it potentially is going to go to the courtroom now.
A century-long rivalry, that's 100 years, so that's really long. Thank you, Madison Muller of Bloomberg, for keeping us updated about all of these things. Later this hour, we'll hear from John Kuckelman, Group General Counsel at Novo Nordisk. And coming up, as earnings season kicks off, Goldman's Ben Snyder has investment themes outside of AI that investors should consider. He joins us next. This is Bloomberg Open Interest.
Goldman Sachs says that high volatility and plunging momentum within the AI trade are good reasons to find investment themes outside of AI. The team led by Chief U.S. Equity Strategist Ben Snyder says compounders with strong earnings growth and returns are trading at a large discount. They also see M&A candidates and consumer experience stocks as opportunistic. So pleased to say that Ben joins us now. Ben, wonderful to see you.
Right.
And momentum in the AI trade has been really hurt. I was just looking at our Bloomberg long-short momentum trade, having its worst month, or on track to, since 2021. How much is that just something temporary versus investors in truly looking out for widening out trades like you're pointing out at this moment?
Well, it's not just the performance. The volatility of momentum has been striking. On our factor, going back 40 years, this is the most volatile momentum has been outside of recessions. And that creates obvious challenges for investors, including the need to just reduce risk in portfolios. And so what we've heard for months is investors asking for investment ideas outside of AI and momentum. And now that we've seen that reversal, those calls for other ideas have just grown louder and louder.
And you argue that the attractive themes outside AI is consumer experiences, compounders, which Danny mentioned earlier, and M&A candidates. Why do these stand out? I must admit, I'm not even sure what compounders mean. I
think that's part of the appeal. The first step was to look across the market and appreciate that many sectors and themes that should be unrelated to AI are trading with a correlation to AI, either positively or negatively. Healthcare, for example, has some connection to AI, but it's trading like the inverse of most AI stocks, primarily from a portfolio flows position. So the first thing we did is look for themes that really are not trading with a relationship one way or the other, and then we looked for places where we thought there were strong fundamental tailwinds. Those tailwinds include strong consumer spending on experiences, growth in M&A, some of the other dynamics you mentioned.
For those who don't know, I happen to have a M&A show every Wednesday, Bloomberg Deals, Wednesdays at noon. Watch every day if you can. So I was pointing at the wrong camera. Watch every day at noon. So if I can ask about M&A, what sectors are you looking at that seem ripe for that would be good for investors to kind of start sniffing around?
So first thing we did is went to our analysts and asked them which companies that you cover look like they have the highest likelihood of being acquired. And our view is if M&A announcements are rising, and as of course you know, they're rising quickly, that should lead to a valuation premium in these stocks. And what they did was highlighted three distinct groups. First, of course, is biopharma, where we've seen the most activity and the strongest performance of stocks in that universe. Second is the broader tech area. And then third is a collection of stocks from other areas, including industrials and energy, et cetera. And it turns out over the last few weeks, all of those groups have started to outperform as those announcements have continued to come through the pipeline.
Okay, Ben, I think you're going to stick around with us. Opening bell just in a few moments from now. Ben Snyder of Goldman Sachs. Let's get a quick check on your markets ahead of that opening bell. And again, we attempt to rebound after 3 consecutive days of declines, up 0.5% for the S&P. The Nasdaq up 1.4%, unbothered this morning by both Brent crude above $90 a barrel and yields now higher by 2 basis points at 461.40. On the other side of this break, we'll have your opening bell. Let's get your trading day underway. This is Bloomberg Open Interest. I'm Danny Berger. Matt Miller is still off for paternity leave. We miss him very much. It's a market that's attempting to rebound this morning, being led by tech. A lot of volatility. Ben Snyder was just pointing this out. The most ever outside of a recession for the momentum trade. Today, it is higher 1.5% for the Nasdaq, the S&P up 0.5%, the Dow up a third of 1%. Down at the New York Stock Exchange, we have a charity ringing the opening bell, the Pan Mass Challenge, some sort of cycling challenge that raises money for cancer research, which is a fantastic thing, with some pretty sweet cycling suits they all have on down there. We have Impinj ringing the opening bell. They IPO'd 10 years ago, so this is their anniversary. They make RFIDs, and they have underperformed small caps. They're still up about 18% year to date. So that's the story with who's ringing the opening bell. Isabel, I know you got some tech stocks on the mind this morning.
We do have some tech stocks, and as you pointed out, I'm wearing green, so maybe that's why the board is green, Danny, but you're looking at stocks to watch, tech lifting the broader market this morning as investors buy back those AI chip stocks at cheaper valuations. So, you know the fears over China's AI progress? Well, they're probably gone now as we approach earnings. We have Alphabet and Tesla tomorrow, so those are the big guys. SanDisk higher by nearly 9%, Intel up by more than 6%, and Nvidia up by 3%. So significant gains here, Danny.
Also at the open, I'm looking at other earnings. We have Isabel, GM. They raised their full year profit forecast by another $500 million after beating second quarter earnings estimates, powered by stronger margins on its largest trucks, but still have headwinds like tariffs and otherwise keeping a ceiling on any gains this morning. We're back with Goldman Sachs Chief U.S. Equity Strategist Ben Snyder. Ben, it's going to be a tough week, or at least a busy week over the next week and a half. You have Alphabet earnings tomorrow. You get a lot of the hyperscalers next week. How important is it to get some positive numbers out of CapEx and a positive reaction to those numbers in order to reinvigorate this AI trade?
We've talked about this on your show before, but really for the last 3 years, the AI trade has been driven by earnings. And this is true for the broad market, and it's true for the AI infrastructure stocks at the center of the trade. And so you're right, coming up to these earnings results, the onus is on the numbers to support this rally. We'll be watching the CapEx, as you mentioned. We'll also be watching the revenue results to see signs of return on investment that, of course, gives a signal about the path of spending going forward.
A part of me thinks that if it's a beat and a raise and it still gets punished, then that's not really a stock problem, but maybe a positioning problem. And everyone is in on this trade. I mean, we do have from your prime services desk, Goldman Sachs, saying that hedge funds have been pulling out of the tech trade for the most in 2 months. What do you make of that?
I think you're right. There's fundamentals here, and then there's technicals as well. We were talking a little bit earlier about the volatility of the momentum trade, which by and large these days, of course, is the AI trade. When that happens, investors need to reduce the size of their portfolios, and we're seeing that play out in the positioning data you mentioned.
I was also thinking on the commodity research side of the Goldman Sachs house. They're warning worst case scenario, if the kinetic war continues in the Middle East, we're going to get $120 barrels per oil. Not their base case, but certainly their most bearish case for it or bullish case for oil. What would that do to this equity market? Because we have seen it shrug off concern after concern, especially the ones of the geopolitical nature.
At the end of the day, earnings are driven not just by AI, but about the macroeconomy as well. And you're right, investors have turned their attention away from oil, in part because energy prices have been falling, in part because consumer spending has remained very resilient. But if we're going to continue to see energy and gasoline prices continue to rise, investors will have to adjust their expectations accordingly.
And one of the questions we have is whether this whole AI narrative is creating a new era of winners or whether it's just pushing valuations too far. How do you square that tension? I mean, it's such an unforgiving market. I mean, Danny and I will really be looking out for these earnings because even if it's a beat, it could just go the other way.
Well, part of the challenge is balancing the near-term earnings outlook with the long-term earnings outlook. For example, very few investors I talk to really think that memory stocks will be the main economic beneficiaries of AI 10 years in the future. The problem is we all acknowledge it's very difficult to know what the world will look like 10 years in the future. And so the result is investors focusing on the tangible, visible earnings today, which is primarily in that infrastructure cohort.
Well, one of the things just on that, Kevin Gordon of Schwab pointed this out on X this morning, that the forward PEs for semis and for healthcare are now equal. They're both trading at 18 times. And semis obviously was trading much higher than that, but in the volatility, it's come down. I wonder what you look at the opportunity set of those two sectors. Like, does it make sense that they would be trading at similar valuations?
Comes back to uncertainty, right? If the earnings growth of semiconductors that we've seen over the last couple of years continues, those multiples are clearly too low. But as we head into the hyperscaler earnings you referenced, investors are asking yet again, as they do almost every quarter, whether this is the quarter we start to see the spending trajectory decline. If so, earnings estimates will decline as well. And in retrospect, those valuation multiples will be justified.
What about the small caps? Let's go into the world of the little guys. They've outperformed even the large caps this year. They've had a great run. Is this the start of a lasting comeback? And I feel like almost every time we talk about, is this the year for small caps?
We wrote about this a couple weeks ago. You're right. The Russell 2000 has returned almost 20% year to date. It's much stronger than most investors expected, ourselves included. I think there are a number of factors here, but one underappreciated driver is the AI trade.
Oh, gosh.
We ran the numbers, and it turns out the AI trade has driven about 50% of the Russell 2000
but question about that, because the Russell 2000 had a big rebalancing, and a lot of those AI stocks moved up into the larger cap universe. Does that make the Russell 2000 less attractive then?
That's exactly right, and that's a major reason why I think we will see weaker earnings revisions and weaker performance for small caps in the second half of the year.
So that one's less loved in terms of the broadening trade, but it does still feel the Russell 1000, so going up into the universe. Bespoke had data out that the 25 best performing Russell 1000 stocks in the first half were down an average of 25.4% in July as of yesterday. This goes back to the momentum issue. So if we're broadening out, why can't we also broaden out to the small cap universe? If the biggest winners, and a lot of them AI, are not performing well, shouldn't there be some element that we can pick up some of those unloved small cap names?
Well, the thing about the Russell 2000 is there's 2,000 companies in there. So certainly some of them will be attractive. And I think it's worth highlighting that the dispersion of returns we see in the equity market today is extremely wide. So there is a lot of alpha opportunity for investors. The issue is, writ large, the Russell 2000 is very sensitive to the cyclical economy. And our view is that the economy remains healthy, but it's not going to be accelerating in the second half of the year, and that makes for a difficult environment.
When you talk to clients, we have around 60 seconds here. Do you feel that they're getting anxious? Because we do have bearish bets against the S&P at around their highest since data going back 2010. So which really shows you the worries and the fragility of the market. What are they telling you? Anxiety
has been increasing very, very clearly over the last couple of weeks, but it's not as high as you might expect. And I think it's worth reminding ourselves the equal weight S&P 500 is just 1% off the high. The S&P 500 is just 2% off the high. And investors who have lost money in the semiconductor trade over the last couple of weeks also made a lot of money in the second quarter. So concerns are rising, but they're not extreme by any means.
See, this is the thing that I always struggle with, because if we are in this world of overvaluations, if it does seem bubbly, if that keeps you away from the market, then you're missing out on big gains. But then if you're riding those gains when things turn, you necessarily get punished because you're not hedging. How do you strike that balance of like, okay, things look a little bit frothy, but you want to ride those gains, but also not get hurt on the other side if there is a downfall?
So I'll come back to where we started the conversation, which is diversification. I think the solution is to maintain some exposure to those trades as long as the fundamentals look solid, but also own some other things like the M&A stocks, like the consumer experience stocks that we talked about earlier.
And compounders.
Correct.
Ben, this has been so fantastic. You please come back again soon. That is Ben Snyder of Goldman Sachs. And let's get a check on your equity market this morning, about 30 minutes into your trading day. And it's a good day for tech. And you can see that just shown by the fact we're up 0.5%, even though there are more stocks moving down than up. That seems to be the case. On many an up day, can we turn around after 3 consecutive days of decline? Micron having a very good day, up 8.4%. Nvidia doing well too. It invested in Nebius. We also learned that TSMC is raising prices, so that seems to help the ecosystem. Again, we get another test tomorrow in the form of Alphabet earnings, and ahead of that, Alphabet is declining, down about 9%, as is Amazon. So the hyperscalers not having a good day. Again, it's the check writers and check receivers that seem to be on opposite sides of the trade. Also, some consumer names not doing well today, too. So if we look at some of the sectors and how those are performing, again, it's going to be a tug of war with tech, but it ends up doing well because of how those semi stocks are doing, but communication not doing well because that's where some of those hyperscalers live. Healthcare, that's taking a beating this morning. Novo Nordisk suing Eli Lilly. At the same time, staples, I mentioned that some of the consumer names not doing well. Energy up 1/3% as the price of oil, Brent crude, trades around $90 a barrel. Isabel?
I'm going to steal your phrase, Danny, check writers and check receivers.
I'm going to be honest, I didn't come up with it. I can't remember who did, and I've said it so much at this point, I don't even remember. But thank you, whoever originally came up with that
You've
phrase.
trademarked it at this point,
Sure.
and in my book, you came up with it. Coming up, we have Novo Nordisk suing Eli Lilly, accusing its rival of misleading ads for blockbuster weight loss drugs. We speak to John Kuckelman, Novo Nordisk Group General Counsel, next. This is Bloomberg Open Interest. Time now for our top call. Some of the analyst action in focus this morning. First up, Morgan Stanley downgrading Salesforce to equal weight, saying the company's AI positioning has yet to drive an inflection in growth. Next up, Bank of America raising its price target on Micron to $1,550 and adding the stock to its US 1 list, pointing to another memorable earnings beat. And finally, we have HSBC upgrading Goldman Sachs to hold, citing the bank's higher earnings outlook and valuation multiple compression. You're looking at the stock higher by nearly 1.5%, Danny.
Isabel, let's turn back to one of this morning's top headlines. And Novo Nordisk is suing Eli Lilly, claiming that Lilly's advertising for its blockbuster obesity shot Zepbound and diabetes injection Mounjaro is misleading. Novo says that Lilly's ad campaigns relate on outdated weight loss comparisons. Eli Lilly, we are out to the company, but they have yet to respond to the claims. Joining us now is John Kuckelman, Group General Counsel at Novo Nordisk. John, thank you very much for joining us this morning. And look, before the court, you have to present this argument. Not necessarily that what they presented is false, but it's factually true but misleading. That's a bit difficult to do. So what sort of evidence, surveys, and otherwise are you bringing to the court showing that consumers were actually misled by this ad and Novo suffered as a result of it?
Good morning, and thank you very much for having us this morning. This is an incredibly important story, and we're very pleased that you're covering it. This is not a complicated case. What Lilly is doing with its advertising campaign is taking the highest dose of its medicine and comparing it to a lower dose of the Novo medicine. And then it is deceiving the people who see these campaigns into believing that the Lilly drug is greatly superior to the Novo drug. So it's not terribly complicated. They're using an old, outdated study that is a head-to-head study, which is no longer current. And if they were using current data, it paints a very different picture.
Got it. So John, again, the question is do you have the evidence that consumers were actually misled or you suffered harm? What sort of argument are you going to bring to the court in terms of actual things that you can glom onto that show that people were actually misled by this?
We do. And what we will show first is that it's obviously misleading. Just on the face of the advertising campaign, it is a misleading campaign. But we also have taken the time over the past couple of months to gather evidence so that we can show that consumers actually have been deceived.
So Novo is asking the court to stop the ads and require corrective advertising. What outcome would you like to see, John? Do you want the ads pulled out altogether? Do you want a disclaimer? Or would the team be happy with an apology? What is the outcome that would be the best in your view?
So the only outcome and the only right thing to do is to pull these advertisements and to pull them this morning. These advertisements are deceiving and they need to be pulled. So we've asked the court for an injunction requiring Lilly to stop these advertisements. But I would compare it to if you pollute the water and then you stop polluting the water, that's not good enough. You have to clean up. You've created a mess and you have to clean that mess up. So we also need Lilly to issue corrective advertising so that the millions, if not hundreds of millions of people who have seen these campaigns get the truth as opposed to the deceptive message that's in these messages.
And I just do want to reiterate to our viewers that we have reached out to Lilly. They have yet to respond to your claims, John. So in this, and you mentioned this at the start, that they're using a head-to-head trial, which you see as old. You have newer, higher dose Wegovy that is more effective. But the FDA itself discourages in advertisements from using cross-trial comparisons. What do you say to that? That would be a problem within itself if Eli Lilly were to make an advertisement, or Novo Nordisk, for example, choosing two drugs that haven't had a head-to-head comparison study.
You're absolutely right. There is no head-to-head study of the highest dose of Zepbound and the highest dose of Wegovy. That doesn't excuse then using an old study that shows the highest dose of Zepbound compared to a lower dose of Wegovy. Our 7.2 milligram dosage of Wegovy was approved in March of 2026. And there is no head-to-head study. So what you really are required to do if you want to make any kind of a claim under these circumstances, you should look at the two most parallel clinical trials of these dosages. And if you do that, and those studies exist, they are randomized, double-blinded, placebo-controlled studies. And if you look at those studies, what you will find is that under the highest dose of Zepbound, the average weight loss was 48 pounds. And if you look at the study involving Wegovy, the average weight loss was 47 pounds. 48 and 47 is a vastly different message than 50 and 33.
John, Lilly has gained momentum in obesity drugs. How do you respond to critics who are saying that maybe this legal fight is more about protecting Novo's position and against Lilly's growing market share?
This is obviously a very competitive market, and you can see that across the portfolios, including the recent launch of the oral Wegovy pill. It is very competitive. But that is not what today is about. 2 weeks from tomorrow, you're going to hear our quarterly results for the second quarter. But what we're focused on today and what we're focused on in this lawsuit is making sure that the people out there across the United States who suffer from obesity and diabetes have access to accurate information, so that when they go and meet with their doctor to make decisions about what is best for them, they have accurate information in making those decisions instead of information that is really deceptive.
John, just on a wider scale, because we have this lawsuit, and then there was also the lawsuit against Hims, which I know since has resulted in a partnership. But should we assume more of this from Novo Nordisk, from you and the team, that this has entered a more aggressive phase of defending Novo and, again, defending market share?
Novo Nordisk is a healthcare company with a more than 100-year legacy of serving patients with chronic disease. We are not a law firm. We have other things that we would rather focus on than filing lawsuits. That is why we're reluctant typically to do it. But in egregious circumstances, we have no other choice. And today we're here. We wish we were not here. And by the way, we've reached out to Lilly months ago to try to resolve this. We didn't even get the courtesy of a response to that. But we would much rather be focused on innovative medicines for people around the world instead of bringing lawsuits. But we have no choice here because of the severity. And I also should add, it's actually a pattern with Lilly. So not only have they done it with Zepbound and Wegovy, they've done it with Ozempic and Mounjaro. And then they also, before their oral formulation was even approved, they were putting information out that it would be superior to the Wegovy pill. But interestingly, they weren't even comparing it to the 25 milligram Wegovy pill. they were comparing it to Rybelsus, which is a much lower dosage, and they were using data from a clinical trial where weight loss was not even the primary endpoint. So this is a pattern, and that's why we felt compelled. We have to step forward now and stop this.
Right, and again, I can't speak on Eli Lilly's behalf. We haven't heard from them, so we can't, confirm whether exactly this is a pattern. But point taken of what you're saying, John. But John, I do wonder if there might be an argument, and perhaps this is what Lilly would say too, that they are just comparing what is usually used by consumers, what's available at the time. The most recent higher dosage of Wegovy was only recently approved by the FDA. How many people are actually using that higher dosage, and thus does it really make sense to use that as the case study for their advertisements?
Well, first, they are comparing their highest dosage, so they would have to ask themselves that question about what they're doing. But I'd like to take us back to the advertisement, and if you just look at the advertisement, it is a very, very bold visual message and a voiceover that tells people who are considering what GLP-1 they should take that with one they can get 50 pounds weight loss and the other they can get 33 pounds weight loss. And that is deceptive. It's not true.
Okay, John, thank you so much for joining us this morning. John Kuckelman of Novo Nordisk. And again, we are indeed out to Eli Lilly. We invite them on the show as well to respond to these claims, and we await any response, and we will bring you it as soon as we get it. Coming up on the show, Northrop Grumman hikes its outlook with its order backlog at a record high. Shares, though, falling more than 4%. That's coming up next. This is Bloomberg Open Interest.
Northrop Grumman raised its forecast, but shares are falling despite a record order backlog. Bloomberg Markets correspondent Nora Melinda joins us live now at the desk. Nora, thank you. It's such a pleasure to have you this morning. Why is this backlog so important? What does it say about the broader market?
Well, it's really important because of the fact that this is future revenue that's already under contract. So the fact that we're seeing $105 billion, that's exceptional. And it essentially has people thinking about the outlook for this company. We've also been hearing from analysts on Wall Street this morning talking about the fact that a lot of the gains in this stock has really been focused on the fact that we've been seeing this demand driven by the wars that have been ongoing. And so there is just a question as to whether or not we're going to continue to see spending on defense accelerating, given the fact that we're still dealing with this geopolitical uncertainty.
Just with all of that, because obviously a huge backlog, a lot of uncertainty. So presumably this is picking up. Can they meet the demand, though? Are there big backlogs that Northrop Grumman and maybe other companies are trying to battle through right now?
And that's the question right now as to whether or not they're actually going to be able to see this forward. But as I'm hearing on Wall Street, it does seem as though there is still demand specifically for Northrop and its peers as we still continue to see countries really focused on advanced weaponry that these companies are able to provide. And that's the tailwind that a lot of analysts are seeing right now.
And talk to us more about B-21.
Yeah, B-21 is essentially the Air Force's next generation stealth bomber, but it's also one of Northrop's largest growth programs. So there's been a major focus here on B-21, and we're seeing that as a potential accelerant tailwind for Northrop more broadly.
Nora, just quickly, because I know you're also concentrated on the home builders, and we had D.R. Horton earnings and another quarter of disappointment. What exactly did we learn?
So, okay, we did see essentially that the company was cutting its full year revenue guidance, and that essentially it was pressuring the stock. As we saw, trading has taken off so far. But there is still some bright spots that we're seeing. There are some bright spots, including the fact that the company has found ways to lower its construction costs, and then also gross margin. That's essentially been the KPI for the industry more broadly. They've been trying to see whether or not these companies are still spending so much on incentives just to lure in home buyers. And we are seeing that D.R. Horton still remains resilient in that respect.
All right, Nora, thank you very much for joining us. That is Bloomberg's Nora Melinda on some of the earnings over the past couple hours. Coming up in the next hour, Oaktree Capital's Danielle Poli is going to be joining us for the entire hour. We're going to talk private credit with Marc Pinto of Moody's, plus GE Aerospace CEO Larry Culp from the Farnborough Air Show and the Hasbro CEO Chris Cox after they reported earnings. You're watching Bloomberg Open Interest. "30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Danny Berger alongside Isabel Lee. We fight for gains after 3 consecutive days of declines. Coming up on the show, tech takes the lead. The Nasdaq pushes higher as investors return to chipmakers.
Stocks shrugging off Middle East tensions. The U.S. and Iran trade strikes for a 10th straight day.
Plus, that war in Iran testing the aviation industry. GE Aerospace CEO Larry Culp will be joining Guy Johnson later this hour after boosting guidance. We begin with investors looking for alternatives to the AI trade. Goldman Sachs chief U.S. equity strategist Ben Snyder weighed in.
The volatility of momentum has been striking. On our factor, going back 40 years, this is the most volatile momentum has been outside of recessions. And that creates obvious challenges for investors, including the need to just reduce risk in portfolios. And so what we've heard for months is investors asking for investment ideas outside of AI and momentum. And now that we've seen that reversal, those calls for other ideas have just grown louder and louder.
Let's bring in Danielle Poli, Managing Director and Co-Portfolio Manager of Global Credit at Oaktree Capital Management. Danielle, great to see you this morning.
So great to be here with you both today.
And look, the loved part of this market, which for a large point had been AI-related equities, has been incredibly volatile. Goldman was on earlier basically saying it's the most volatile it's been outside of a recession. Credit, though, has been remarkably well behaved. Why do you think there's such a difference between the two asset classes right now?
Credit is pricing in resiliency, but selectivity matters. What that means is the income that investors can earn from credit remains high and stable, kind of counterbalancing that volatility that we're seeing in equities right now. But the key is selectivity, because we are starting to see this dispersion with borrowers, and you have a lot of cross currents going on. Tariffs, geopolitics, there's no shortage of things that are rocking equity markets, and they do have their impact in credit, but on the most vulnerable borrowers in the space.
So you mentioned selectivity, and in your notes you said it's a picker's market. So what separates the winners and the losers in the credit markets right now?
We love this credit pickers market at Oaktree because it plays to our strengths, bottom-up fundamental analysis, and being very disciplined in our underwriting. So we have elevated rates, and that has increased the interest debt burden for a number of borrowers. And so we have to be mindful of the tail. My colleagues on our opportunistic distressed side of the business shared with me that there's about $200 billion of capital right now of borrowers that have yields over 15% or are trading below 90 cents across around 250 borrowers. So that's really the next kind of opportunistic wave of opportunities that we'll see, but there's still, solid, stable companies in the high yield bond market that you can invest in and get, a decent yield when you're putting together a portfolio today.
I do wonder, though, with some of the AI names, again, not as dramatic as equities, but if we are starting to see some pushback, I was just looking, I did this on Ask Beyond the Terminal, or Little AI, basically saying, look at all the hyperscalers and how their debt is trading. And among 32 that have issued debt this year, all of them are trading below par. It's worse if you have, a 100-year debt, for example, or if you're priced in sterling, which Alphabet is. But I wonder if there is obviously some idiosyncratic things going on in the UK, but if there is starting to be some pushback against these hyperscalers and the amount of capex and the spending and the amount that they're tapping bond markets to do so.
Yes, I think that the hyperscalers have issued so much debt, and they are going to have to face higher financing costs. You're also starting to see some political pushback about where data centers are getting built. And you also still have to commercialize and show that you're turning in that CapEx spend into profit. And so I think you're right to point out that the market is starting to differentiate or be a little bit more mindful of investing in the trend.
You also talk about some building in the distressed debt world. What will get us away from building to the real distressed debt cycle?
Yeah, the back the truck up moment isn't here yet. I think you need to continue to see elevated rates. I think increasing rates, if we do have wars really focused on inflation and rates go higher, that is going to put pressure on some borrowers. And we also have a maturity wall that's coming, 2027, 2028. These were deals that got done kind of between 2020 to 2022 with around 6-year maturities. A number of these borrowers have done liability management exchanges that have kind of pushed the can down the road, but these are hard maturities coming up. And so I think that could create that distressed moment that we've been waiting for.
Is it then alarming that energy prices are starting to rise again, considering that the war in the Middle East is yet again in a kinetic phase?
Yes, I think just energy and commodity prices rising is generally challenging for a number of companies that are seeing their input costs increase. And the question will be, can they pass through those costs to their consumers? I really think that the lower end consumer is continuing to be punished by higher oil prices, higher cost of goods. They are already in a recession recession right now, while top earners are continuing to spend. If we do see equity market weakness, could they pull back on spending? That's a concern of ours as well as we think about the overall health of the economy right now.
Does the rebound in the tech change the attractiveness of the credit at all, or do you think that yields still make the case?
I'd like to see, a little bit more volatility and better pricing on some of these AI deals, at least before I get more interested on the credit side. I think it's great to participate in AI from an equity perspective, but in credit, we're capped on our upside. So for us, it's all about avoiding the losers, letting the winners take care of themselves, ensuring that we're very low, on our default risk.
By the way, you said dispersion is really starting to take hold in these credit markets. Do you see the same for things like AI infrastructure deals and the things that have been really hot in this market?
We haven't seen it yet, but I think when you do have such significant growth in any market, you have a loosening of lending standards. Forget a little bit of the discipline involved, and you'll get that dispersion later. So we're starting to see it now in private credit, where there's been significant growth, and you have, a tail. So we're seeing it there now, but not yet.
But by the way, when all the first brands and tricolor things were happening, people were like, okay, you can put aside the fact that these were obvious frauds, but maybe it does signify that underwriting standards were getting loose. Did we not learn from that moment that there needs to be more due diligence and there needs to be tighter underwriting standards? Did we kind of put that to the wayside, and just because competition has become so robust?
Yeah, I think we did put it to the wayside, especially for something shiny and new that can continue to deliver those types of returns that individuals are looking for in their portfolios that maybe they had looked to private credit to deliver. And I think it's just systematic of the market. We go through cycles. We see kind of euphoria, and then we see the consequences of that later down the road.
Danielle, thank you for those fantastic insights. Danielle, Poli of Oaktree, sticking with us for the hour. And turning to the Middle East, Brent is moving above $90 a barrel as the U.S. and Iran exchange strikes for a 10th straight day. Let's get the latest from Bloomberg Washington correspondent Tyler Kendall. Tyler, again, this is now the 10th straight day. It's dragging on. How do we know whether this will be a lasting conflict or whether this is still contained?
That is the question, Isabel, that Washington is trying to figure out at this moment. We're getting conflicting signals. I'll give you one example. On one hand, we've heard from mediators that they are actively working to prevent further escalation and violence. But then at the same time, within the last 30 minutes, we've gotten confirmation from both Kuwait and Bahrain that they are working to intercept Iranian drone and missile attacks. And that timing is very interesting because Bloomberg News had just confirmed that Iranian officials are in Pakistan right now for another round of talks, potentially to get us toward some sort of ceasefire, though at least publicly we've gotten very little indication that there has been movement on this front, including when it comes to Iran's leverage in the Strait of Hormuz. Just overnight, we saw another tanker attacked in the Strait, this time linked to Kuwait, as new satellite imagery from research firm Kepler shows us that on average 10 ships transited per day, Friday through Sunday, almost all exclusively using that Iranian approved route instead of the U.S. coordinated one. And then, of course, adding to the supply disruption and risk, as we've discussed on this program, we are now seeing this threat from the Iranian-backed Houthi rebels when it comes to a maritime blockade of Saudi Arabia. And new this morning, Bloomberg News was able to obtain this memo that outlines that the threat is extending to any ships going to and from Saudi Arabia's ports, not just Saudi-flagged vessels. Isabel and Danny, we've discussed before that we can't only see this particular thread of the conflict through the U.S.-Iran war. There is a separate ceasefire from 2022 that's breaking down between Saudi Arabia and the Houthis, but we do know that it has the potential for some pretty major disruptions to the tune of about 4.5 million barrels per day that Saudi Arabia exports through that Red Sea route.
Tyler, thank you very much for that update. That is Bloomberg's Tyler Kendall in Washington, D.C. Let's get a check on your markets this morning because we are about 40 minutes into your trading day. Tech is still leading us higher, though off of some of the biggest of gains that we've seen this morning, up just more than 1%, up 0.5% for the S&P. We are going to get Alphabet earnings tomorrow. Danielle, if I can quickly turn to you, how much, I know your credit and not equities, but how much are you looking at Alphabet earnings tomorrow to maybe shake up or make a difference for this market?
Generally earnings have been pretty strong, and we're expecting to see continued growth from, some of the similar in this cohort. And we expect it for credit as well. overall, things seem pretty resilient with everything going on in the macro backdrop. You haven't seen what's happening geopolitically and what was just discussed with the Strait of Hormuz impacting these companies and their earnings or the forward guidance that they're projecting.
Pretty remarkable to see. I have a feeling we're going to talk about this for the rest of the hour. Let's first, though, get some of the single stocks that are moving this morning. As we mentioned, tech lifting the broader market. Fears over China's AI progress seem to be dissipating, at least for now. We still await earnings from Alphabet and Tesla tomorrow, Isabel.
And General Motors, Danny, raising its full-year forecast profit by another $500 million after beating second quarter earnings estimates. This, of course, is powered by stronger margins on its large trucks. You see the stock there popping nearly 4%.
And Isabel and I recently speaking with Novo Nordisk, who is currently suing Eli Lilly in U.S. federal court, claiming that Lilly's advertising for its obesity shot Zepbound and diabetes injection Mounjaro are misleading. Eli Lilly has yet to respond to the claims. We will bring you any response as we get it.
And coming up, Marc Pinto of Moody says dispersion is widening in private credit. He joins us next to discuss his outlook. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. JP Morgan CEO Jamie Dimon reiterating his criticism of the UK's bank tax surcharge. Dimon warning that UK Prime Minister Andy Burnham that tax hikes could drive capital away and have, quote, adverse consequences. He also said UK politicians should be worried about the number of companies that have been delisted from the London in recent years. And a new report from Bloomberg NEF finding that data centers are on track to account for about 20% of America's electricity consumption in 2035. That's up from 5.9% today. In states like Virginia and Texas, where data centers are concentrated, their share of electricity use will be even higher. And the general manager of Nike football saying that the World Cup ending was, quote, not what we dreamed of. This comes as two Adidas-sponsored teams faced off in the finals. Nike-sponsored France and England both lost in the semifinals, leading Nike to miss out on the merchandise windfall. I can't say I really know about sports, but Danny is the biggest fan.
I got a little bit of hate yesterday for saying that the world was cheering against Argentina. I don't know how incorrect. Did you watch the World Cup at all, Danielle?
No, but I watched your comment.
Okay, yeah. Not everybody loved
it.
But also, England-France was the real final for anyone who cares. So you still did a good job, Nike, and congrats on that. Let's turn back to a world that perhaps we all know a little bit better. That's private credit. Marc Pinto, global head of private credit at Moody's Ratings, publishing a new note writing, quote, bottom line dispersion is widening, not a uniform downturn. Good underwriting is starting to matter more than it has in years. Almost exactly what we heard from Danielle just moments ago. I'm so glad we're all in agreement. Marc joins us now. Of course, Danielle Poli of Oaktree is still beside us. So in April of this year, Marc, first of all, great to see you.
Thank you.
In April of this year, you downgraded your BDC sector view to negative. What if anything, has changed since then?
Well, we've assigned a few new negative outlooks to some of the names because asset quality is deteriorating to some extent and leverage is starting to rise. But to the point that Danielle made earlier and you just mentioned, there's a huge dispersion. If we look at the 36 or so BDCs that we rate, those that show the strongest asset quality have a 0% non-accrual ratio. And those that are seeing some difficulties, the worst three, let's say, the average non-accrual rate is 8%. So that's a pretty dramatic difference.
So non-accruals at their highest in several years. Is this a warning sign, or do you think is this simply a return to normal, so to speak?
I think it's a little bit of a normalization. It's a little bit of seasoning that's going on in the market because overall, if you look at the non-accrual rate, it's still under 2% for the BDCs. So we expect some continued deterioration, but we're not ringing the alarm bells as yet.
Maybe staying on those alarm bells, Marc, I caught your conversation at Bloomberg Invest with my colleague Millwood, which was focused on systemic risk. It feels like the conversation has shifted a bit since then. What do you think investors should be most focused on right now within the private credit asset class? Yeah,
that's a great comment. You know, this market is continuing to evolve. It's a maturing asset class. It's not a shrinking one. And in the context of that growth, it's not just growing, but it's changing shape. There's a fundamental shift in the center of gravity for private credit. And that's because the borrower base is changing. There are two letters that are impacting this market in a big, big way. And there are four new risks.
So, okay, now we have to ask. Please get into the 4 new risks.
There you go. All right. Well, maybe we could take them in turn, right? So what's happening is, in terms of the borrowing base, it's moving from the equity-sponsored company who's borrowing to larger borrowers, investment-grade borrowers, and investment-grade structures. The 2 letters that are impacting this market, AI. No big surprise here. And really, it's interesting because it's both a tailwind and a headwind. It's been a headwind for the BDCs that have 20% exposure to that sector, and there'll be winners and losers there. But the tailwind here is all about AI compute, and private credit is massively involved in AI compute, and that tailwind is much stronger than the headwind. 4 risks you asked. So it's not just about will the borrower default. It is what happens when they do default. And so you need to think about structure. How was the investment vehicle built? That's the first risk. The second is the sponsor. Their sponsor risk. They have a lot of discretion in how they execute on their mandate. That's a second risk. The third is around valuation. What exactly is the collateral worth? And the last is liquidity. Can I get my money when I need it?
I want to hone in on the private credit question because we at Bloomberg always talk about it, and honestly, every story gets a lot of interest. So it's moving.
Maybe less so now, though. By the way,
maybe less so now.
Like they're getting less clicks. Just putting it out there.
Less clicks.
I better start working harder.
Yes. Okay. Maybe you'll answer this. So private credit, they're moving up the quality spectrum.
Yes.
They're financing a lot of investment-grade borrowers. So does it make the sector safer or more complex? How should we look at it?
I think it's still complex, again, because you have new risks that you need to analyze. So it is investment grade, and I think some of the structures are getting tighter because, and you were all talking about this as well, AI compute is requiring a lot of capital. We see about $800 billion this year, $1 trillion next year, and perhaps more after that. So if you're going to go into the market and you're going to be asking investors to lend you money, you need tighter and tighter structures because they're going to become more and more disciplined. And Danielle, I think you were talking a little bit about that. Investors need to be disciplined, and there's not this idea of, can I get access to private credit, but which private credit shall I get access to?
Yes. Focusing on managers who are being very disciplined and underwriting in this market. There's something you said earlier I thought that was interesting, was just the shift from private credit from more of a sponsor-backed direct lending market to a structured market. And that presents risks as well.
Absolutely.
And you've talked a lot about the difference between structured and securitized. So I thought you might want to share some of your latest work there.
Private credit today is largely structured credit, but structured credit is not the same as securitizations. So some of the rated note feeders, these closed-end fund structures that will have direct lending underneath it as its collateral, looks quite similar to a CLO. But it's not the same thing as a securitization and a collateralized loan obligation. That's a very tight legal structure that is hermetically sealed, where the cash is trapped there. In a rated note feeder or these new private credit closed-end funds, there can be cash leakage, and that's why the sponsor is so important to what kind of risks I'm taking on and what my ultimate return is. So I think it's very important that the market understand the difference between structured credit and securitization.
But as we're moving into this world, and you also point this out, we're having more things like joint ventures, payment in kind, especially as we move into the world of utilities. What does that mean for the transparency of these funds? Because private credit has gotten a few knocks lately about transparency issues.
Yeah, it is not the most transparent market, and in many respects, it maybe never will be. In the public bond market, you get price discovery every minute, every day. You're not going to get that in private credit. There are some private credit lenders that are seeking to mark to market on a much more frequent basis. We'll have to see how that all plans out. But I think this market, there's a trade-off. You are entering into a lot of these investments with the liquidity, the illiquidity, but I do think transparency can improve. Regulators are very much focused on trying to create more transparency, as well as we are at rating agencies trying to provide more information to the market so they can feel more confident about how they invest.
Doing the Lord's work, Marc.
Oh, geez.
Thank you very much for joining us today, for joining Isabel, Danielle, and myself. That's Marc Pinto of Moody's Ratings. Still ahead, we are live at the Farnborough Air Show for a conversation with GE Aerospace Chairman and CEO Larry Culp. You're watching Bloomberg Open Interest. You're watching Bloomberg Open Interest. A check on your equity market nearly 1 hour into your trading day as stocks continue their Tuesday rebound. After falling for 3 consecutive days, the Nasdaq up 1.3%. It is the tech stocks and the semis that are leading us higher. The hyperscalers doing a whole lot of nothing to lift us higher ahead of Alphabet earnings and Tesla tomorrow. Brent crude, though, look at that, up above $91 a barrel. Continued threats in the Middle East. It's not just the Strait of Hormuz anymore. It's also Houthi rebels threatening the Red Sea and Saudi and other ships' ability to cross through there, what they've really used as a cudgel to help prevent or get around some of the blockages in the Strait of Hormuz. Intel, that is moving higher. Reports suggest that they are cutting back on some of their data center spending and staff. GM reporting earnings that beat. Northrop Grumman now moving lower, down 2.2% with a huge backlog. And Eli Lilly and Novo Nordisk, both of them are up. Eli Lilly up 1.5%. As Isabel and I have been discussing so far this morning, Novo Nordisk out with a new lawsuit against Eli Lilly, saying that they have unfair comparisons in their most recent advertising, that they're comparing not the same drug. They're comparing a lower dose Wegovy that should be compared to the higher dose. We've heard back from Lilly. They say this, quote, the gold standard for comparing medicines is a robustly designed, well-conducted head-to-head clinical trial. Rather than compete on the merits of its product, Novo is asking a court to stop Lilly from communicating the results of that trial. We stand firmly behind our advertising. This is something we had asked Novo Nordisk about, the fact that this is a head-to-head trial, and that's what the FDA recommends that companies do.
And they also say that their ad is truthful, transparent, and grounded in the most direct scientific evidence. And we asked earlier the general counsel, and he was like, I want them to pull out all their ads.
Yes, yes. Again, he says it is misleading because they're not comparing it to the highest dose Wegovy, which does have better results. Coming up, we're going to be at the Farnborough Air Show. That's next. A check on markets, and will they stay this way after we get Alphabet earnings tomorrow and the bulk of big tech next week? The Nasdaq up 1.5%. That's being supported by the chipmakers, which also gained yesterday, despite the fact that the overall market fell. It was 3 straight days, but the pressure is in yields this morning, up 3 basis points, with Brent crude up 2.6% at $91 a barrel. Now, I want to welcome to our global TV and radio audiences. I'm Danny Berger. Let's head down to the Farnborough Air Show, where Bloomberg's Guy Johnson is with the GE Aerospace Chairman and CEO Larry Culp. Guy.
I certainly am. Thank you very much indeed, Danny. Yes, welcome back to the Farnborough Air Show here in the UK. As you say, Larry Culp is with me. Larry, great to see you. Thanks for spending some time with us. Look, the first thing I've got to ask you is, why on earth are we sitting in front of a very big 747 with your name on it?
Well, it's the GE Aerospace name. Guy, good to be with you. This is our flying test bed. As you say, this is a 747-400. This is basically our airborne laboratory upon which we test all of our engines. There's a lot of talk here at Farnborough, as there often is at the air shows, around the future of flight. We wanted to bring the flying test bed to Farnborough just to reinforce and help people understand everything that we do on board and inside the plane, to make sure that we're bringing forward the best possible engines from a safety and reliability perspective.
You're going to test the next generation of engines for narrow bodies like the 737 or the A320s on this, because there's a big debate here at Farnborough about whether it's open rotor or the traditional kind of ducted jet engine for that next generation. Is this the aircraft you'd use to test that?
Very much so. So even though it's a wide body engine, we can test virtually any engine that we might fly across our portfolio under development on the flying test bed.
Cool. Let's talk a little bit about the show and what has happened here. I'm sure you've been absolutely snowed under, meeting after meeting. What I've seen come out of the show is, again, huge numbers of orders for aircraft, which means huge numbers of orders for engines. You've just landed a huge deal in India as well. The backlog is getting bigger and bigger, Larry. It's a nice problem to have, but at some point, are you going to have to invest in additional manufacturing kit in order to fulfill some of these huge orders that you're taking?
Well, guys, it's been very busy. We've been here since Saturday, and I don't think we've had a better air show. From an orders perspective, we've had a number of announcements. I think the one you're referring to is one we let out yesterday afternoon. Over 1,000 engines with Indigo Airlines in India. Really excited about that multi-year commitment. There are others. I won't take our limited time here to go through the roster of them.
There are many.
There are many, narrow body and wide body. Guy, we've been investing in our manufacturing footprint, in our supply chain for years. We know that a good air show is interesting, but we're on a multi-year ramp, both with our commercial customers and in defense, right? We're sold out into the early 2030s. So whether it be investments in fixed capital, just as importantly, investments in people and process, those are the things that enabled us, say, in the first half of this year, to increase our engine deliveries by over 30% year over year. We're going to need to be driving that sort of improvement, that sort of growth for years to come.
Does that pace increase? Does the cadence of that start to increase? As you say, you're sold out for years and years to come.
Well, I don't think we need to necessarily compound at 30%, but we're going to have to do more in the second half of this year than we did in the first half, and 27 is going to need to be bigger than 26. So we know we're on a multi-year ramp, and what I'm so excited about, we said this last Thursday at our earnings call, we've got 9 quarters in a row now where we've seen double-digit sequential increases from our suppliers that are probably prone to pace us the most, which tells me they're investing, we're collaborating to break bottlenecks where they exist, and we're able to get more from them. In turn, we're able to deliver more to our airframe and airline customers.
Do you think you're going to have to invest more in that? You did highlight that. It was something that really stood out in terms of what you said on that earnings call. But is there something, do you think you're going to have to invest more in that supply chain? We've talked about kind of investing in your capital infrastructure. Do you think you're going to have to invest in theirs? Is there M&A stories that maybe you think about in order to just get that supply chain to where you want it to be?
There's more to come with that, without doubt. Most of that will be organic, right, within our operations. Some of it will come by way of collaboration. I'm sure there'll be inorganic investments as well. We've done a number of small acquisitions with suppliers that were better off, frankly, under our roof than at arm's length. But at the end of the day, it's not about ownership. It's about problem identification and breaking those constraints. Again, I think we've made a lot of progress the last few years in partnership with a number of our key suppliers, large and small, many of them here. More to come.
Okay. There's been so much news flow as we've been here at the show. One of them has been around what is happening with oil prices and the fact that we're seeing them heading back up again as a result of what's happening in the Gulf right now. If I talk to Kelly over at Boeing, if I talk to Guillaume at Airbus, they're like, this is in some ways good news for us, because what it does is it encourages our customers, the airlines, to invest in the most up-to-date aircraft, the most fuel-efficient aircraft that they can get their hands on. For you, though, I just wonder whether it's a slightly different story, because what we do see as well is that the airlines look at their older fleets and go, maybe we should retire some of those older aircraft. But the spare parts business is a big margin driver for you. How do you see the balance working there?
Well, I would say what's good for Boeing or good for Airbus is good for General Electric. Okay. There's no two ways about that. But the other piece of the equation right now, Guy, that you didn't touch on, frankly, is demand. Every airline CEO that has been at Farnborough, those that we talked to just a few weeks ago at IATA in Rio, all have remarked about how strong demand has been, even in the face of some of the oil price disruptions since the springtime. So we're looking at a situation where we have very strong aftermarket demand, we have very strong new make demand, and again, we can never forget about defense. So we have our work cut out for us on a multi-year basis. We know we're going to have to ramp. We're going to make those investments, drive those process improvements. But that work is underway at GE Aerospace, and that work will continue.
One of the big discussions here has been almost about the aircraft that's not here, and that's the next generation of narrow body. We talked about it a little bit earlier on. You're going to test it on this 747, the engine for that. You're pushing quite hard for the open rotor technology. You think that's the future. You think it's going to be simpler, easier to maintain, have some fairly big cost efficiencies that come with it. The airframers aren't there yet. They don't appear ready, judging by the conversations that I've had, to be ready to make a decision on that. How late can they leave it? When do you think that decision is going to come?
Well, we had an announcement just yesterday in concert with Airbus, with CFM International, where we're talking about our new flying test bed equivalent for the open fan architecture. It's a technology development program. Guys, as you well know, this is a multi-year effort. We do think the open fan architecture provides both efficiency and maintenance or cost of ownership benefits. So we think we will ultimately be able to deliver to the airlines, the ultimate customer, an opportunity to do both. It's not yet a product, so there's work to do here. There's plenty of time for us all to work that out, but every next generation narrow body has always come forward with a step function improvement in performance. Very hard to justify the investment to develop one, let alone buy one, without that. We're confident that the open fan architecture is going to be the enabler in that regard.
Larry, it's always a pleasure. Thank you very much indeed for spending a little bit of time with us here at the Farnborough Air Show. We greatly appreciate it. Larry Culp, the CEO of GE Aerospace, joining us here at Farnborough. I'll hand things back over to you guys in New York.
Guy, thank you very much for bringing us that conversation. Bloomberg's Guy Johnson with GE Aerospace CEO Larry Culp. Let's get back to these markets, though. We are at a session high of an NASDAQ that's up 1.5%, up 0.6% for the S&P. Again, all of that happening despite the macro headwinds and geopolitical headwinds we are facing. Brent crude is nearing $92 a barrel. Yields are up 3 basis points to 462.61. And yet, maybe we're whistling past the graveyard, or maybe earnings are more important. Some of the single stocks we are looking at this hour. Northrop Grumman raising its full-year sales forecast as a flood of new orders pushed the company's backlog to record level. Shares fall 2%.
And 3M topping Wall Street's profit expectations as the slow and steady turnaround effort continues despite broader economic volatility. You see the stock popping almost 10%, Danny.
And Novo Nordisk suing Eli Lilly, accusing its rival of misleading advertising in U.S. markets for obesity drugs. In an emailed statement, a spokesperson for Lilly said that the company's advertising is truthful and transparent, and that Lilly will defend against the Novo lawsuit vigorously.
Coming up, another hiccup in Paramount's proposed takeover of Warner Brothers. We'll bring you the details next. This is Bloomberg Open Interest. Paramount's $110 billion takeover of Warner Brothers has been put on pause. A federal judge has temporarily halted the deal, saying it likely violates antitrust laws. Paramount says it will vigorously defend the deal. Let's get more with Bloomberg Media editor Chris Palmieri. Great to have you here with us in the New York studio. So what concerns are they exactly raising, and what evidence do they need to present that, yes, this merger will indeed harm competition?
Well, the state attorneys general have argued several points that the combining Paramount and Warner Brothers is going to give them a big share of the movie business, even bigger share of the blockbuster films, and also big share of cable TV. I mean, you think of all the channels that we're combining here: CNN, HDTV, MTV, all of that. So that's the state's argument. Paramount, of course, says there's so much more to entertainment these days than cable TV and the movies, right? Everything from Netflix to YouTube and all that, and that's why they want to get bigger and compete with these tech giants. So that's their argument. The judge has already indicated that there's some validity to the state's concern. And then so August 3rd is the next hearing on this, and that's when the judge will decide if there's an extended injunction going all the way through a formal decision on the case. So that could push things into next year. Very bad news for Paramount, yeah.
Question, taking a step back from the specifics of the deal, does this ruling introduce execution risk for other M&A, or maybe put a chill on some of the lofty M&A expectations that we have for the remainder of the year?
Yeah, there's definitely been a feeling that under Trump, it's sort of everything goes, lots of approvals, and we've seen some wacky things. I mean, just in the media space, it was Nexstar buying Tegna. Similar situation, there was a lawsuit, they closed the deal anyway, and then the judge said, hey, you can't actually physically combine these two companies, even though you did. Wow. And so, that's something Paramount's probably going to be considering if they want to try to close this deal, even though they have these court, things hanging over them if they don't get this injunction. It's a really crazy time, certainly, for media M&A.
Chris, can you go over just how expensive this is for Paramount, Skydance, every day that this deal doesn't happen, and if it eventually does fall through?
Right. So starting the end of September, there's what they call ticking fees. Every day it's about $7 million that Paramount has to pay Warner Brothers shareholders. So it adds up to about $600+ million a quarter. And then if the deal completely falls apart, there's a breakup fee of $7 billion Paramount has to pay to Warner Brothers shareholders. That's on top of the $2.8 billion Paramount paid Netflix to go away from this deal. So imagine being in Larry Ellison and David Ellison's shoes, spending almost $10 billion potentially on a deal that doesn't close. It's a crazy situation.
Do you think Ted Sarandos is feeling pretty good today, looking at this lawsuit?
Very much so. He's out there buying little studios and things like that.
I was going to say, he's not done either. Chris, thank you very much for joining us. Great to have you here in New York. That's Bloomberg's Chris Palmieri. And catch Bloomberg Deals. That airs every Wednesday at 12 p.m. New York time. So tomorrow we will be talking about the story again. Coming up, Hasbro shares surge after the company raises its outlook. We're going to be speaking with the CEO, Chris Cox, next. This is Bloomberg. Welcome to our global TV and radio audiences. I'm Danny Berger alongside Isabel Lee and Danielle Poli. Hasbro shares are surging after the company raised its full-year outlook, topping second quarter expectations, with Magic the Gathering once again driving growth. The franchise topped $500 million in quarterly revenue for the first time in its 30-plus year history. Joining us now is Hasbro CEO Chris Cox. Chris, wonderful to have you on. Congratulations for this milestone. And I know that this has been a huge part of your growth strategy, and it's paying off with Magic the Gathering. But I do have to start out asking, last time you and I had spoken, one of the other big parts of your growth strategy was your video game division. But you've now announced that you're canceling multiple video game projects. Can you just walk us through the thinking?
Well, I think most video game companies in a given year will have a variety of products in different stages of development, and we're no different. I think what we did is over the last 6 to 9 months, we took a relook at our portfolio and said, okay, what can Hasbro be best in the world at? What can we uniquely do differently than anyone else? And we decided to refocus. And, the decision we made was trading card games and role-playing games were really vital to franchises like Magic the Gathering and D&D. We're doubling down on those. But other categories like strategy games, action, stealth, we work with over 1,000 partners around the world with a very large licensing business. We're the #1 digital licensor in the world, working with nearly 100 partners. We can work with those kinds of partners who are experts in those genres and create a real 1-2 punch. Hasbro being a leader in TCGs and RPGs, and then our partners really helping to extend our brands elsewhere. And that's really kind of what today's messaging was all about.
And sticking with games, how are you using AI when you develop these?
AI is still pretty early days. We use it across the company, mostly for productivity. Our toy division does it for some concepting, but at the end of the day, a human is driving all of the taste decisions and the ultimate execution. Inside of games and video games, I would say AI is basically not used at all. Will that change over time? I think we'll look at what the state of the tools are, where the industry's going, and certainly we will use what makes sense. I think the video game industry has a real history of being an early technology adopter, and we'll take our marks from what the best in the business are doing.
What are you seeing with respect to consumer behavior or demand that's maybe not yet showing up in the data, but that you're planning for?
Well, gosh, I think the biggest thing that we're seeing is this boom in these categories that we call Gem Squared. Those categories that are gamified, entertainment-driven, multi-purchase, and multi-generational. I think other companies maybe call it kidults. That's been a power trend over the last couple years, and we certainly see it taking off moving forward. I think you're seeing that in strength with Magic the Gathering. You're seeing that with growth that we have in Marvel and Star Wars, which is really fan-generated. The kid business continues to be good, but fans are really what's being explosive in that. And with new initiatives like we're seeing with traditionally kid products like Play-Doh, with what we're doing with the new product called Blooms, which is an ability for older consumers to create beautiful bouquets of flowers to build and display. I think that build and display dynamic, that play being more than just something for kids, collection being more than something for just nerds like myself, but much broader, I think that's powering the entire play industry right now and is a power trend that I don't think is going to go away anytime soon.
Can I just say, I think nerds is better than kiddled. Like, I would rather be referred to as a nerd than a Kindle. I'm just going to put that out there, Chris. Look, when it comes to maybe some of the more like traditional toys, the things that rely on imports, I know this industry has had a lot of volatility. And at the moment, the White House has been relying on Section 122 tariffs that expires this Friday. How are you and the team thinking about that expiration? Are you looking at any hedging options, bracing for anything in particular, especially as you start to lock in holiday shipments?
I think it's been a pretty volatile environment over the last couple of years between trade policy, commodities pricing. We've certainly seen that with oil. I think our focus is just let's have really good, solid fundamentals. Let's have a broad-based, diversified business where we don't rely too much on any one thing. For Hasbro, we have Magic the Gathering, which is a huge power brand for us. We have a huge licensing business that's heavily diversified, and we have a beloved toy business. And so I think by having that diversification, by having brands that have a variety of different target audiences, we're able to weather whatever the market or whatever policies are thrown at us. And I think that underlies kind of the strength and bullishness of the raise that we had for this year and our midterm guide for 2027 and beyond.
You mentioned Magic, and we know that it keeps driving your growth, but do you think Hasbro is becoming too reliant on one power franchise?
Well, I think what you don't see maybe under the hood and an artifact of our reporting is just how big our licensing business is. Hasbro is the third biggest licensor in the entire entertainment industry, behind, I think, only Warner Brothers today. That's a big business for us that's very profitable. Sizing it, I'd say it's $700 to $750 million, generating operating profits in excess of 60%. So when you think about Magic, that's a big business for us. But when you think about that licensing business, that's also another very strong leg in our stool. And then when you couple with that with a very diversified toy business that goes across a whole bunch of different categories and a whole bunch of different audiences, I really think Hasbro's a multi-leg story, a multi-leg growth story, and a multi-leg profit story, with each of them starting to fire on all cylinders, like what you saw last quarter and you saw continue into this quarter.
Yeah, this quarter's revenue was very high, and your business has been extremely resilient to what's been going on in the broader economy. My question is around the consumer, and if you're seeing any slowdown in spending in any particular segments or anything that might impact future revenue.
I think if you would have asked me that a couple quarters ago, we would have said, yeah, we were seeing more of a K-shaped kind of recovery or K-shaped consumer behavior. But if anything, we're seeing broadening strength in the consumer. We're seeing it across price points. We're seeing it across demographics. We're seeing it across income groups. The toy industry as a whole is up over 3% through May. Hasbro is certainly benefiting from that, and it's very broad-based across multiple retailers, multiple genres, and multiple consumer types. So,
yeah, hey, Chris,
from our vantage point,
I just want to jump in.
Play, the consumer is strengthening.
I just want to jump in just because we have 45 seconds left. I know you know the GameStop business well. You partner with them. Again, just quickly here, any thoughts on Ryan Cohen's attempt to buy eBay?
No thoughts on GameStop's overall strategy. I'm glad that they're leaning into trading cards and collectibles. They're one of our fastest growing accounts. And so we're partnering with them closely on that.
Very well diplomatically answered. Love that, Chris. Thank you so much for joining us. Hasbro CEO Chris Cox. And Danielle, thank you so much for joining this hour. Such a pleasure to have you.
This has been so fun. I keep buying more toys. Love the Play-Doh.
You almost bought the Bloom toy too, right? The adult Play-Doh. Yes,
with young kids,
that.
lots of Play-Doh in our home. Thank you both so much. It's been a real treat.
So great to have you. You'll have to buy Bloom, come back and join us and give us the review. Danielle Poli there from Oaktree. Coming up tomorrow, Isabel and I speak with Wells Fargo plus Nadia Lovell and Jordan Jackson.